New figures released by the Bank of England show that the amount lent out in mortgage debt has hit its highest level since 2008, raising fresh fears of a new housing boom. Sky's economics editor Ed Conway is here with me. So what do today's figures tell us, Ed?
Well, I can show you this on our exciting new touchscreen, actually. We had some new figures out from the Bank of England which showed you just what is happening to mortgage lending. This just shows you how much banks were lending out each month over the course of the past few years. And look, since 2008, since the crisis, you can see that this has been more or less on about the same kind of line until the last few months. As the last few months, just look at what happened.
Shoots up.
It shot up very sharply indeed. Such that actually, at the moment, in the past 3 months, you've had £6.8 billion lent out to families for mortgages. How
much of a concern is that figure? Are people borrowing too much?
Well, I think to find that out, you have to examine just how many of these mortgages are high-debt mortgages. And I can show you that too. I mean, this shows you, basically, the scale, the proportion of mortgages which are over 4.5 times a family's income. In other words, high-debt mortgages. And you can see this pink line shows you London. That's basically the London housing market getting very sharply. More than 20% of people buying mortgages in London are buying high-debt mortgages, but the same goes for most of other parts of the country as well. And you can see that's just kind of risen recently. But this is where the financial crisis happened.
This is the banking crisis. People couldn't borrow.
That's the banking crisis. But since the banking crisis, things have shot up in terms of just how much people are buying high-debt mortgages. So that has got worse there.
We talk a lot, and we're going to continue talking a lot about the cost of living crisis, aren't we? Mortgages are, for most of us, the biggest expenditure that we'll have.
Exactly.
Are they manageable?
Yeah, and that's the question, whether can people actually afford to kind of keep up their monthly payments? And I've got a chart that just shows you that. This is basically how much of your monthly bill is going into interest payments on your bill. And you can see, basically, on your mortgage, you can see interest payments back in the kind of late 80s, early 90s. Those interest payments, I'm going to just show you, actually rose. Around this period, they rose to about a quarter of the average household's kind of average bills. Now it came down a bit after that, so you had the big housing crash in the early 90s there. It came down a bit, and right now it's still around that kind of 10 to 15% level. It's still hanging around that level. So a lot of people would look at this and say, actually, it's all right. These mortgages are pretty affordable for people.
Yeah, but that's because, presumably, we've had low interest rates for quite a sustained period now.
That's the killer kind of concern, is that just look at that period there. Interest rates at this stage, when mortgages were just as kind of expensive as they are now, were about 5%, whereas now they're 0.5%, so interest rates are very low at the moment.
And the expectation is they're going to go up. What happens then?
Well, keep an eye. So basically, that's where interest rates are at the moment, 0.5%. And almost every investor, these are just expectations, these colourful lines just show you expectations from various different investors about where rates are going to go up. And you can see at the end of we're 2014 at the moment, yep, coming up quite sharply there, according to different investors there.
Rate decision on Thursday. What should we be looking out for there?
Well, the expectation is that rates are going to come up at some point, and you can see that kind of sharply, but it's not going to happen this week. It may well happen towards the end of this year, or maybe early next year.
Ed Conway, thank you.